Well, we've had some interesting comments so far, I think, and some of the standouts maybe from Olivier Garçon. He's saying there'll be no rolling back of regulation, but there will be tweaks to make things more proportional, which I think Michael would welcome, but it sounds like he's not going far enough. So we'll see next week when we get the publication of the final law. Perhaps we can start really with how far should the European Commission go in changing the rules? And you all have a couple of minutes to make some introductory remarks, the ones who haven't spoken before the panel, and maybe give us a flavor of, in the cumulative impact of rules, what would you like to see change? Maybe we can start, we've heard the policymakers, maybe we can start with the banks. David.
Well, I was asked, does this work?
Yep.
I was asked to think about a question, and the question I thought about, I'm afraid, was fairly shot out of the water from a European point of view by Mr. Garçon, because he said many of the things that I wanted. But I do think, thinking of the title of this panel about cumulative impact, the FSB, as was said, is starting the process. I think it's very important for them to do two things. One is to work on the methodological approach. One of the problems that we've raised the issue, we, the Institute of International Finance, have raised the issue of cumulative impact for many, many years, going back at least 5 years. We published a major study, was rather shot down by the public sector, I'm afraid. And one of the arguments is always that it's just methodologically too difficult to analyze all of the moving parts to do a cumulative impact analysis. And that's sort of true. I can very much sympathize with that. Nevertheless, I think we need to have a system that allows for a comprehensive adjustment. We do need some serious methodological work to be done there, and the FSB is starting to do that. In the course of doing that, I think the main point that I want to make is you can get bogged down in very formal methodologies using central bank data and sort of come out 5 years from now or 10 years from now with nothing. It's important to have the formal methodology. It's important to look at the cross-border data. But it's also important to look at other data. And something that we just said in a consultation to the IOSCO, which is looking at market liquidity issues, is that it's very important, in addition to looking at the gross data, to talk to market practitioners, have a sense of what's really going on, get the feel for the market from day to day, as well as the data, which tends to lag by several months. And that's in many ways what the Commission has already done with the call for evidence. I think that's been a fantastic exercise, and we certainly welcome that. I welcome very much the tone of Mr. Garçon's discussion of that.
Any surprises?
No, I don't think so. I think maybe we're a little bit surprised at the enthusiasm of the embrace of the concept, but that's very good. And what I think we also need to see is ongoing consultation with practitioners, people who are actually in the market, buy-side, sell-side, investors, all kinds of practical input on a continuous basis. So that's also easy to say and hard to do, but I think the Commission has started that with the call for evidence and needs to be institutionalized both at the international level and as well as at the European level. Now that doesn't answer any of your questions, but that's what I've set out to say.
Okay, well, I'll come back to you. Let's start with the other three speakers at the far end. Maybe you can start with any few introductory points of what you've heard so far, and how are you seeing the whole process of addressing the cumulative impact? Yep.
Should I start?
Yep.
Actually, I heard the messages, and it's interesting if you listen basically to that theoretical approach that we see there, and what then as a counsel to banks and financial institutions, so the persons who are at the receiving end of regulation, what actually happens. And I actually very often say or think, rather than say that the difference between theory and practice is much smaller in theory than in practice. Yeah? And just to give some anecdotal evidence, yeah, because actually I think we are still missing somewhat the very framework to tackle it systematically. So we, to a certain extent, are somewhat restricted to anecdotal evidence. But if you look, for instance, in the ECB supervisory framework, yeah, and these fantastic theories about the national supervisors being kind of client interfaces to the ECB, collecting data, preparing decisions, the ECB then deciding. So if you look into it, theoretically that might be great. Practically, it doesn't work at all. Just anecdotically, if you see into things like shareholder control procedures, national regulator collects data, ECB then, based on this data, decides after national regulator basically said that the file is complete. So what's the practice actually? The national regulator collects data the ECB doesn't need, doesn't collect data the ECB needs. Then you actually get the message by the national regulator, file is complete. Then if you do M&A, for instance, you have these clauses in the SPA that are based on the DEMA periods kicked off by that. And then in the very last day of the DEMA period, the ECB actually comes back to you and tells you you have two alternatives, as always. Either they will basically not approve because they don't have sufficient data. Also, not having sufficient data is not a reason for not approving. Or you voluntarily withdraw your application and refile it to basically start a new DEMA period. The error, the flaw in the approach is so evident for every practitioner. If you ever did shareholder control procedures in the past, you knew it's a dialogic process. You cannot basically say somebody collects all the data and another person makes the decision based on these data, because they might simply have different frameworks. And you see that basically almost everywhere. Yeah.
I mean, we know the banking union is a learning curve. It's a learning experience in a way. It's something so new. But are you confident there's a mechanism to correct these flaws? Or is it where you go to say, this is not working, we need to change it?
It's actually a very heavy burden on business. Yeah, as there might be a learning curve. Let's say 5 years ahead, national regulators might finally know what the ECB wants to see in every conceivable case. But up to then, you actually cannot really do SPAs in M&A context in the financial industry in a proper way. Yeah. So the question is actually, should we continue that way to basically, on the basis of untested hypotheses and theories, regulate and then just look what happens? Or should we actually get back to an environment as we had it some 15 years before? If I remember, basically in the transition between Basel I and Basel II, years of quantitative impact studies and so on, and finally Basel II came. Well, if it was perfect, let's be silent about that. But the methodology was totally different. So today we often have the impression, and impression to a certain extent is reality, yeah, that all these consultations are to a certain extent moot because the next round of drafts is already prepared before the end of the consultation period. So you actually invest a lot of work into trying to actually give the practitioner's view to certain issues, but afterwards you almost always have the impression nobody is actually really interested in it.
Well, that's interesting. I'm sure Olivier would probably not agree with that. Maybe Verl, any lessons from academia? We've heard the theory of the banking union, all that, not really working in practice. I mean, what do academics have to teach in this situation?
Well, I would like to contribute to this discussion on the cumulative impact of the measures taken by raising the question how financial institutions can still succeed in complying with this massive amount of new regulation. I think the European regulator likes competition, also in the financial sector. I think the European regulator doesn't like too big to fail. And then the question is, how can especially small financial institutions still comply? They don't have big legal teams, they don't have big compliance teams. And even for a big financial institution, this is a problem today, I think.
Well, we've heard there's more proportionality coming on the way,
Yeah,
lighter reporting requirements. Is that sort of thing we need?
I think it might be part of the solution, although I'm convinced that when it comes to consumer protection, there shouldn't be two levels of consumer protection. Also, small financial institutions should live up to the same standard. Sometimes, if they have only one business line, for example, it can be, it's normal that they have a smaller regulatory burden, but I wouldn't say that is that is because of their size. It's just because of they have a smaller one business line, for example. When it comes to prudential regulation, on the contrary, I think that evidently, as it is already partly today, for big financial institutions which face systemic dimensions, they can face a higher regulatory burden because they create more danger for society. On the other hand, what I would like to bring into this discussion is the idea, it's a kind of new buzzword in financial regulation today, I think, is RegTech. You might have heard of it, it's in the neighborhood of fintech. It means that financial institutions try to automate compliance by creating IT solutions. This is often projected as the solution to the compliance challenge. And I think it is the solution. There is probably no other way. It is said to be cost efficient, it reduces the risk of liability, but I do think there are some challenges, to say it nicely, or even problems. If obviously in such an automated compliance solution there is an error in the system, the consequences are much bigger than if you just have one employee making a simple mistake one time. If you have an automated solution, the error will be multiplied. And the problem becomes even bigger if you have the same system used throughout the market or by a large part of the market. I think then RegTech might create even systemic problems. So that is really a problem, I think.
If you had one change that Olivier should make next week in his, what would that be?
I think the change would not so much be a change in legislation, but a change in how the supervisor guides the sector. I think today, I know in some member states, guidance is much better and quicker, but in some member states it's really slow, and the market is really left blind for a very long while. They're trying, for example, like today, they're trying to implement the PRIPS regulation, they're trying to implement the MiFID II, but they don't get any guidance or very little guidance from their supervisor on what, for example, a target market means, on what the rules concretely means. And I think that is really necessary very early in the legislative process, get very detailed guidance. Only in that way, the systems, automated systems, can be built correctly and sufficiently in advance, because building such a system obviously takes a lot of time.
Which is probably difficult to do, because we get the level 2 RTS is so late now, and they'll be changed, like we've seen with PRIPS.
And that's maybe another...
It's a moving target in many ways.
Yeah.
Katja, as you know, are you worried that we heard Gerson saying no rolling back, just making tweaks, just making things more proportional for simpler, less complex banks? Are you worried at all that we will be rolling back?
Well, there is like this divergent views about society has about financial regulation and a financial sector as a whole, because they don't really society don't understand the financial regulation and the complexity. What they understand that somebody has to pay for if something goes wrong. So we lived in this dogma that markets are very efficient, and there is an invisible hand that is going to guide, and there's an equilibrium that is going to guide to that. But we were slapped by this hand, and it didn't work. So the next best solution would be to regulate. Of course, there is no really point to blindly regulate and without looking back of what did we do right or wrong. It's just asking the right question of what financial sector do we really need? What type of growth do we really need? And for who the sector is being created? Is the sector that is kind of self-rolling, that they don't need anybody else, they just need another non-financial institution to have as a counterparty? Or is somebody that actually in the long term provide the growth and jobs that we are looking for? And I think this is the thing that the policymakers should focus, that what type of financial sector and regulation in the long term do we need?
Any couple of changes you want Michael to vote through in econ in coming months?
Well, we know that we have a lot of reviews. For example, there was this whole Basel discussion, and we talk a lot about proportionality. So proportionality is very important. But then we are telling that internal models are good, and that already put the small banks in disadvantage because they're using the standardized approach. Right. And then the whole world is using standardized approach. So the question is, are we giving the incentives to really big banks that they can manipulate the models, or are we trying to create level playing field?
Okay. I think the title of this is Assessing the Cumulative Impact of Regulatory Measures So Far. Can we really do that with Donald Trump in the White House? He's promised to rip up DoddFrank. He may do that in the next few months. As Michael was saying, perhaps Basel should go on a holiday for a few weeks and then come back and see exactly what Mr. Trump is going to do. What should we do? How should Europe respond when it assesses the cumulative impact of regulation? We have the CRR coming out next week, draft amendments. What should Europe be doing, really, with an eye to what's happening in, or may happen, in the United States? Anyone, Michael?
Yeah, if we look back to the history, we know the weaknesses of regulation, and we have seen where were the weaknesses of the markets, and especially the big to fail problem. I think made it obvious that we should come back to the circle of action and liability. With the US government, and that was your question, I really think we have to bear in mind that the Europeans have implemented Basel for all banks, the US didn't. And then they came later with Basel III and said, yes, now we will do it. And if we now get the announcement that the new administration will really leave that path and will not be willing to implement Basel or even wants to re-enter in liberalization, deregulation process, then we have to be very, very careful. Because if we look at the surrounding of the European finance industry and our bankings, we have still a sovereign debt topic in some states. We still have the topic of recapitalization of banks. We still have a stagnation topic with low growth.
Low profitability.
And low profitability. And then we try to increase from the regulator side the necessity to have more risk-weight assets, the capital requirements, and that will end in deleveraging. And if we are deleveraging the European banks, then there will be an open space for competitors and who will come in it. And from that point of view, I think we have to be very clear about that. Is that the intention of policymakers? And from my point of view, I would be very careful, and therefore we have to wait till we know the direction of the US administration.
David, are you jumping up for joy with Trump in the White House? And what could
Well,
happen to Dodd-Frank?
That would be a topic that would be more fun to address off the record. I think clearly, there are things that everybody needs to be attentive and concerned. There are many unknowns, known unknowns and unknown unknowns, I'm sure, as to where things are going to go. So I don't think that's necessarily very profitable to speculate on this at this point, because it's very clear that the administration is just forming, and we don't know where it's going to go. On Dodd-Frank, there's been a whole range of different things said about the extent of Dodd-Frank reform. So there will certainly be some. Whether it will be the right Dodd-Frank reform, I don't know. From the industry point of view, there are a number of things that I think even Barney Frank would admit are kind of wrong in Dodd-Frank that need to be corrected. There are other things that the industry would like to keep in Dodd-Frank, such as Title II, which is the orderly liquidation facility. So it doesn't really help a lot to speculate on that. Let me address a couple of other points that have come up along the way. I think, first of all, it is important, and one of the unfortunate things about the Basel IV debate is that it sometimes comes down to US versus Europe. I think it is important to recognize that the US did implement Basel III in the sense of having the regs on the books. What it didn't do was to approve the models for a very long time, and that's because the regulators took a very rigorous view of that. And what the U.S. banks have today with CCAR and the rest is in many ways a very gold-plated version of Basel III. I think, maybe to go to the point that you made about making a choice of what financial system we want, there have been a number of choices made in the regime that we have now that's being implemented. And among those choices are a choice to disfavor markets, to disfavor investment banking, to disfavor trading, and to some extent that reflects an appropriate technical analysis of the risks of those businesses. But on a number of issues, such as the net stable funding ratio, such as the treatment of derivatives in the fundamental review of the trading book, such as the treatment of cross-holdings for market-making purposes and TLAC, a whole bunch of other things, I think it's arguable that we've chosen a market that is too little liquidity, does not give the incentives, especially in Europe, does not give the incentives to investment banking, bringing savings together with investment. So I think there have been a lot of changes, choices made that need to be revisited and rethought. I think also it's very clear that we would say, a lot of other people would say, Basel IV, as we're not supposed to call it, is over-engineered, and we need to get back to a more appropriate and also more risk-based system. It is a total myth that banks are gaming the system of the risk-based system. There's very good analysis of that. There is, however, a need to provide more uniformity and consistency. We made 78, if you can believe it, technical suggestions to improve the consistency and comparability of the risk-based system. Some of those are things that banks can do. Some of them are consistent regulatory choices, et cetera, et cetera. So I think it's very important not to oversimplify these things. Very important to try to make sure that we deal appropriately with things like market liquidity, because everybody needs that, especially investing.
Okay.
And to end up with a Basel system that does maintain an appropriate degree of risk sensitivity.
Okay. Questions from the audience? Do we have any questions? There must be some questions. No questions at all. One interesting point was what Kai Verl was saying. It seems to be implying that the problem may be more of supervision rather than the actual rules, and the way that supervisors should maybe think on their feet more and make changes in how they apply the rules. Do you agree with that? Or, I mean, being a legislator, obviously, it keeps you in work, changing the rules, but yeah.
Yeah, if you discuss with supervisors and with banks, we realize, yes, we've made a binding European legal framework. Many things are new. Many things are only developed, and they are now implemented in these phases. I think it's not a question of a gap between theory and practice, because theoretically that is quite clear that there must be a learn curve. And your question was, what should be the approach? I think I think indeed that supervisors should be aware that this is a new ground, and they should use their powers in a very responsible way. And I would not say that they are not doing it, but at the moment we have huge discussions in practice, and we realize that there is an uncertainty in the supervisory authorities themselves, where they really do not know what the impacts of their supervision in fact is in the banks, and we should really encourage both sides to come along with that very quickly in the learn curve and do it then in a I would say, politically, not legally, in a pragmatic way, because from my understanding, in the end, in the final situation, both supervision and industry are sitting in the same boat.
Mm-hmm. Alexandra?
Maybe just a few practical comments on supervisory structures. And I can say that Deutsche Basel Group, which delivers the full set of the value chain, basically today is confronted with every type of supervisory structure that exists in the European Union. And that is, if you look at the trading layer, we have federal supervision. If you look at the clearing layer, we have national supervision plus the EMIR colleges. If you look at the settlement layer, that's national supervision, again, for the different settlement, different CSDs we have. If you look at the trade repository, we have European supervision purely. That's the only one ESMA is fully in. And coming back to what we've heard on the learning curve, I think just reflecting on what our experience is, when EMIR was introduced, of course, it took some time, to get all the processes right, and how do we interact with BaFin and BaFin with the college, and what role does ESMA play in all of this? And I can say that it has proved to work pretty well over time. Admittedly, there was a need for a learning curve, so we are pretty confident with the structure that we have today. And in particular, in that case, and I think this comes back to the point, how can we integrate the national supervisory authorities much stronger in the process with the ECB supervision, is that you can definitely say that you have a great proximity of national supervisors. So they should know their markets and their institutions best. So I think if you want to overcome those problems in the processes, it needs a strong dialogue and really taking that expertise of the National Supervisory Authority into context there. So
Okay. Any questions from the audience? No? Yeah, pretty sleepy today, I think.
No supervisors here.
Yeah. One thing, since now Europe is moving on to reviewing all the reforms it's done, and more focus on implementation and reassessing, is it not time to give a proper funeral to the bank structural reform bill? Isn't it time to get rid of it? It's past its sell-by date? Mobile phone.
Yeah, well, that's our favorite file. So we would like to keep it alive. I don't think in this political momentum it will stay alive, but there might be a surprising comeback, because we're putting a lot of trust that the resolution will work. And it won't, because there are several factors that are going to come into interplay. So we have the political will, and there is none, to use bail-in tools. Because the bail-in tools seem to be like this egg that nobody really wants to touch, and the politicians are going to do everything to avoid touching it. And then we will have an angry anti-bank populism that are going to go to vote for somebody who is going to tell them that they are going to split the too-big-to-fail banks. And we see it among the European voting trends, that everybody seems to be so surprised that how it's possible that somebody goes and works for the anti-establishment movement, and then one of those promises and many of the elections that will come will be just that. So then it will be the push from the bottom-up push to bring the reform.
Okay. Well, is there still an academic case for...
Well, I think there is still an academic case, but I think that the problem is political will today, and that there is a problem. The post-crisis pendulum...
The banks have won, then, you're saying?
Well, yeah, I think that there's just some fatigue, some regulatory fatigue, both by the sector, obviously, but also by the regulator. You already see that they are not able to come up sufficiently fast with level 2 and level 3 on the existing measures. So I think that only from a practical point of view, there's not really much willingness anymore to create new legislation which will have very heavy impact on the sector.
So regulatory fatigue, you're saying, and lack of political will. Kai, do you see any...
I think it's even exhaustion, not fatigue anymore. For sure, there is a steep learning curve. But once you think you have finally come ahead of it, actually the regulation has changed. Yeah? So you begin again. And that somewhat gives you the impression that to a certain extent the legislators do not really know themselves what they want, that they are to a certain extent also heeding to, let's say, populistic approaches, bashing the banks. Yeah? If you think about things like the way regulation killed securitization in Europe, yeah,
But we have new regulation trying to bring it back to life again.
Yeah, it's that. So it's very difficult to actually resurrect the dead. Yeah, but actually, what happened? What happened? There was a theory that there was missing interest alignment, and because of that allegedly missing interest alignment, securitizations didn't work, and so on. So actually, the theory is wrong, because the originators had massive interest because of the servicing rights. And the issue was not missing interest alignment, but the theory that the housing prices in the US would basically increase by 5% every year forever, which couldn't work. Based on these assumptions on models in the US, the regulatory framework in Europe was changed, although there was basically not a single European securitization that had failed. Yeah? And now we are here and we have the mess, because the banks are not able anymore to properly use securitization to offload risk from their balance sheet, distribute it to the markets. That cumulates with other regulatory impacts on risk-weighted assets and so on and so on. And there's a very unfavorable interplay between actually accounting on the one hand and capital requirements on the others. It's even more interesting when you look into the current Basel IV discussions on the one hand and the IIS discussions on the other, where basically while in Basel IV there's now a move away from internal models, we see a strong move towards internal models on the accounting side.
Yeah. So basically, you don't expect anything to happen soon on the bank structural reform?
Unluckily not.
Yeah. Michael, you probably have more insight than any of us.
In securitization, as ALDE shadow, I have an insight, but I cannot tell you about here in detail, but you are there on the right track. But I would like to comment on the banking restructuring side. That is an ultima ratio, which we should have in mind, and I think we still have some scientific work to be done if we have the finance market as a global market to analyze the competitive surrounding with asymmetries if there are big players somewhere else. So let us, for instance, take state-influenced banks or even state-owned banks in China. If we compare that with the actors in the United States, there are small and big ones and so on. There are Main Street and Wall Street banks, we know that. And if we then compare it with us and with other parts of the world, if there is an open capital market with free floats. But I just wanted to raise your awareness on the phenomenon of common ownership. Common ownership means that asset management funds the same are invested in the same banks and also in private companies in other sectors, and then they come easily to majorities of the shareholders. And if we look at that, I have read some studies of professors in the United States. They come to the conclusion that that is an attitude or behavior which is comparable to the trusts in the 20s. And if we look at that, nobody really can predict what the outcome of these common ownership studies will be in future, because the US answer in those days was an antitrust policy. And that would then end up in restructuring requirements. So I would not predict that we will never see it, I can only invite everybody to a discussion which I'm organizing on the 6th of December together with Professor Martin Schmalz in the European Parliament.
Let's conclude on a note that.
I can't let the bank structural reform go by.
Okay.
Okay. I think
10 seconds.
It takes more than that, but I think if you want to have a regulatory pause, the bank structural reform is not the way to do it. That's a very, very complex issue, easy to say, be wildly complex to execute in any way that would not be seriously destructive of the European banking system. So that's the first. Second point, I think it's just ways too facile to say. It's easy, it's cheap, it's wrong to say that resolution won't work. There's a huge commitment to resolution in the official sector. Huge investments have been made by the SRB, by the banks. There's a very strong case to be made that where the plan is in place, when TLAC and MREL are complete, it will occur because there's a strong desire politically and regulatorily to make it work. There's absolutely no basis, and it's very irresponsible to say it won't work.
I have 10 seconds, can I?
Quick.
It didn't work in Italy because there were no political will. So you cannot say that without political will the resolution will work.
Okay.
We're not to the point yet.
Which leads nicely to a final point before we break up.
May I do a quick remark on the common ownership issue? Because I think to a certain extent it shows how schizophrenic regulation is, because on the one hand, everything is basically driven towards ETFs, which replicate the markets, and then when that's done, all of a sudden there's a complaint that actually the outcome is that the ownership structures are the same.
Okay. Just wanted to give the signal we're working.
Yeah. to finish off, final thoughts from you all. Are we really targeting the right things here? We're spending an awful lot of time trying to review rules we put in place. But 10 years after the crisis now, we still have problems at Deutsche Bank, at Monte dei Paschi, massive amounts of non-performing loans. And some economists are saying those are the problems that are holding back the economy in Europe, not sort of undercapitalized banks. Isn't it time really maybe for a refocus on what are the real problems in the banking sector? Anyone? Yeah.
Well, I think on the non-performing loans, that's absolutely right. Clearly is something that's holding back Europe, not only directly because of the cost of the NPLs, but also because the existence of the NPLs in some banks in some countries is tainting the image of the overall European banking sector, raising funding costs and also contributing to the Basel IV discussion. So the NPLs are very destructive. The one glimmer of hope there is that the ECB is making a very serious effort to focus on NPL. They are working on it. They just published a massive paper on guidance. There's an interesting idea to have a kind of NPL exchange that would allow, for the first time, a structured market to develop that would provide a clearing price. So there's some hope there, but one of the first things the US did was to get rid of those kinds of problems. Although NPLs are rising very slowly now, it's overall been solved. So I think getting the NPLs out of the way would be a major step forward.
Anyone else with a comment on if we're focusing on the right things?
Well, I think that crisis is never a good moment to make a new regulation and to change something into regulation, because you have to adjust the screws that were loose and allow a certain thing to happen. And this is a constant problem of regulators, the inconsistency of timing. Because when the timing is good, they make the regulation more lax and allow for the short-term growth and boom, not concentrating on the long term. So I think right now it's a good moment to really look back. We have the cumulative, but what sector do we want? Because we cannot really afford the next crisis.
Well, some regulators are hoping they can iron out the cycle in regulation, the dynamic approach. Alexandra, final comments?
Just a quick comment. I think we're talking a lot about banking regulation. I think we shouldn't lose track of the capital markets union here. And if we're talking about jobs and growth, I think it's very well known that SMEs will need alternative for funding, and obviously they won't be coming from the banking side. So what we need to step up really is a funding escalator for the different types of SMEs across Europe. And I think yes, We need to take care of banking, and I understand the concerns that we have in terms of will BRRD ultimately deliver what's written for? But I think we do have to focus also on the solution, not only on the problems.
Okay.
Unluckily,
quick comment, just final
yeah,
comment?
quick comment. Unluckily, regulation makes it so difficult to sell equity to investors, in particular to small ones.
Yeah. Okay. Well, any final quick
I
comment?
think we have enough rules, and I think we have good principles now, which maybe lacked sometimes before the crisis, principles on which the specific rules are based, and that the issue today is making sure that there's compliance with the rules, and then the question is how, but I already talked about that.
Okay. Well, final word from...
Yeah, from my point of view, we clearly see that regulation alone is not solving the problem. We need to have in an economy real growth, and the US have cleaned up a bit more decided than others. But if you compare Italy to Germany, except of German bank, who was very proud not to accept state aid, all the others cleaned up, and so you have 120 billion guarantees for hyper real estate. You have the state resolution payments for 16 billion, for instance, for the resolution of West LB, Landesbank, also the Bavarian Landesbank, also the HSA Landesbank, and you also have the state shares in the Commerzbank. And if you look at that, why did Italy not have this state aid to clean up? They couldn't, because they had the sovereign debt gap. And from that point of view, there is a tragedy that they are late coming. And so we come back. If you have a multiplication of problems with a sovereign debt, with a low-grade stagnation and a low profitability, you cannot believe that you introduce rules and regulations, and then the problems are gone. So the Europeans will have to go a quite stony way. And the major question should be the focus on how to create growth. And with the growth, you create jobs, and with the jobs, you create the opportunities to have the money to clean up.